First of all, a very good afternoon, and thank you for taking time out of your day to attend this webinar on affordable education and unlocking the benefits that we provide to some of our clients already. Just by a quick introduction, my name is Shaileen Shah. I am the Managing Director at Mann Limited. We're a firm of accountants and, more importantly, tax advisors, as well as registered probate practitioners. I run a team here in Northwest London, in Edgware specifically, but obviously with the way the world is right now, we can pretty much cover any area within the UK. This webinar has been brought about again by several conversations we've had during various school runs in terms of what I call the playground conversations around VAT and school fees. I want to start off by saying that this webinar will be looking at the overall planning around school fees and not necessarily just VAT and how to avoid that. I will cover that in a short while. The fundamental problem that we have is school fees. School fees that are roughly £20,000 a year net of tax. When we do the numbers, it means basically we've got to earn roughly £36,360 gross before tax to end up with £20,000 in our pocket. Similarly, if you've got two children, then you pretty much double those numbers straight. With VAT kicking in, and I am aware schools are sort of passing on that from January of increases of between 12 and 14%. I only know of one school, which I won't name, that have said for the first year we will be taking in the VAT and not raising our school fees, which is great. But effectively, we're going to end up paying for this VAT over the next couple of years, or from next year, from next September, whereby suddenly that £20,000 school fees will become £24,000. In this respect, the gross earnings will have to jump to £44,000 before tax to end up with £24,000 in our pocket. And again, if you have two kids, you pretty much double that. So for example, if you've got two kids, you've got to have £88,000 of gross earnings before tax to then benefit from having kids in private school and paying £48,000 in school fees. So we've got the solution to this, and effectively the way we are looking at it is how do we cut back that gross earnings before tax to end up with the same amount in your pocket. As an example, again, with our solution to pay £20,000 of school fees, we are saying that the gross cost to you as an individual will be £21,857.50. Again, these are just approximate figures. And again, to get to £24,000, the £44,000 cost will drop to £26,857.50. So again, if you double that with two kids, then you're looking at a figure of roughly £53,000 to be earning, as opposed to earning £88,000. Now you can see clearly that 36 in the first instance, or that 44, has dropped significantly down to £26,000, which is more or less the fee before the VAT. So this is the solution we have. The question is, what's the answer? What's that one word answer? And the one word answer is using trust structures. Trust structures have been in play for a number of years. I think they've been there for probably a century or plus. And again, I'm not going to go into the history, but this is something that I personally have been working with for over 20 years myself, and these are plain vanilla stuff, planning wise, that we can take care of. So in terms of using trust, there are tax efficient payment of school fees can be made. What it effectively does is it utilizes the child's unused personal allowance. So every child born in the country from minute one is entitled to £12,570 of tax-free income. It therefore reduces the cost of school fees by up to 45%. And this area of tax planning, as I mentioned earlier, is not considered high risk. It's all plain vanilla planning that has been in play for over centuries, I think. And for me, the biggest advantage of all this is the inheritance tax benefit that it provides. So trusts have been in play and predominantly have been utilized as a way of saving or reducing inheritance tax burdens. But this is basically killing two birds with one stone. Not only are you planning for your inheritance tax, but you're also taking advantage of the income tax benefits that it provides. So some of the questions, I want to sort of start off by talking about what trusts are and how the trust structure is laid out. So you have the trust in the middle, and you've got settlors that will settle an asset into the trust, which is then effectively managed by the trustees. So the settlors, who can also be the trustees, will pass the asset to the trustees to say, can you please look after this for me for the benefit of the beneficiaries, i.e., which could be anyone, my children, my great-grandchildren, however you want to do, my nieces, my nephews, however you want to set it up. The only thing that the settlors cannot name as beneficiaries are they themselves. So you would have the settlors who will pass on the asset to the trustees to say, look after this for the benefit of the beneficiaries. The settlors can be trustees, which gives them an element of control, but they cannot be beneficiaries. The beneficiaries would be children, grandchildren, great-grandchildren, nieces, nephews, whoever they want them to be. So what types of assets can you settle into the trust? You can settle cash into the trust. You can settle property into a trust. And you can settle shares through the trust or land. So again, land can be useful, especially when planning can be obtained, and therefore there'll be a spike in your value of the estate. Taxation, how is the trust taxed? And often that's the sort of first bit that comes through. Going back to my lovely diagram where the trust has a settlor that settles an asset and the trustee that looks after the asset, i.e. manages it, making sure, for example, if it's a rental property, making sure rent's collected, property is insured, etc., repairs are dealt with. And beneficiaries at the bottom. But I've this time added one more, which is the HMRC, and just because I want to show you what happens in terms of taxation. So let's take an example, income earned by the trust of £10,000. The trust will pay tax at 45% on that £10,000, which is basically £4,500, which leaves a balance in the trust of £5,500. Now this £5,500 will be distributed to the beneficiaries should the trustees want to, so there's full discretion. But let's assume that they do, and it just makes sense because you'll see in a second why. Let's look at it from the perspective of the beneficiaries then. The beneficiary will receive income of £10,000. with the tax credit of £4,500 applied to it. So basically it's £10,000. They then have a personal allowance of £12,500, which means that there is no tax to pay on the beneficiary. And the tax of 4.5 that has been paid by the trust will be refunded due back to the beneficiary. So the circular motion of the trust earning 10,000, paying 5.5 to the beneficiaries, and the 4.5 thousand to HMRC, which the beneficiaries then do a claim back via a refund. There you go, that's the summary. They end up with the £10,000 completely free of tax. And don't forget, this would have obviously incurred tax if you had this income being generated on your own. I'm going to take another example just to run through, saying, what if the beneficiary received £20,000 of income? So again, the reason why we've used £20,000 is that sort of the school fees that you would pay on an annual basis. As long as the trust generates that, it would pay £9,000 to the HMRC, i.e. 45%, leaving the 55%, £11,000 to the beneficiaries. Beneficiary will do a tax return to say that they received £20,000 gross with a personal allowance of £12,570. That leaves them with taxable income of £7,430, on which there is tax at 20%. They've already paid £9,000, so therefore they'll be due a refund of £7,500, giving the beneficiary a total of £18,514 of earnings, of net receipts from a £20,000 earning. Why trust? I talked about this. There's a lot of flexibility. The trustees will have, the settlors, who can also be the trustees, will have flexibility on what happens to the income that the trust is generating. Beneficiaries could be paid or could not be paid, so it's totally at the trustee's discretion. There are significant capital gains tax, income tax, and stamp duty land tax benefits. So we've talked about the income tax benefit, whereby the income is completely tax-free. What about capital gains tax? So transferring assets from yourself to children would trigger a capital gains tax charge. By using a trust, it defers that capital gains, thereby effectively you're not paying it right now. You may pay it in the future when the property is eventually sold. And it only makes sense because when you eventually sell it to someone else, you've made the money, let's pay the tax at that stage, rather than doing so right now. And stamp duty. So this is one of the big areas that we get questions on. Clients want to transfer properties across into individual children, but the children haven't bought their first home. So by setting a trust structure, you therefore not then triggering the second home stamp duty when the child eventually buys that first property. Again, inheritance tax and estate planning, like I said, this has significant benefits in the long term as well. To give you an example, if you transfer a property into a trust today, it's outside your estate within a 7-year period. And subsequently, when the child comes to do their own estate planning, it's outside their equation as well, because technically they don't own it. It's in a trust, and the trustees are the ones who are legally obliged to look after that property. And for the record, it doesn't fall into the trustee's estate either. And asset protection is another benefit. Again, children are young, you don't know what they're going to do with the asset. So it gives you that protection that they can't go and blow that asset off into something that you didn't want to happen. So there you go. There's some asset protection there as well. I've got a question here that says, is SDLT due when you transfer the property into the trust? No, is the short answer. Absolutely not. There is capital gains that is deferred, so there's no capital gains due either. Sorry, when I said that there's a stamp duty benefit, I meant when the beneficiaries come and buy their own property, whether that's 15 years later, etc. They don't own the property, so that's still their first purchase of the property, whenever that is in the future. What's the downside? Again, in full transparency, the downsides are ongoing record keeping. Effectively, you've created a separate entity, which is subject to tax. It needs to have filing done. Restrictions on settlement. So there's only a maximum of £650,000 that you could settle into a trust every 7 years. If you settle anything more than 650 as a couple or 325 as an individual, you would be subject to what we call an entry charge, which would be 20 or 25% depending on who's paying it, on the amount above the 325 limit, £325,000 limit. Setup cost, again, as a downside. For me, it's a one-off cost that's taken care of. But for me, the bigger downside is growth and lending. We found that obviously growing if it's a property portfolio beyond the asset that's there, especially if it's unencumbered, you will struggle to get lenders who are willing to lend. So that becomes a consideration when you're taking into account whether you should set up a trust or not. The legal and administrative complexity, again, the trustees are legally obliged to look after the asset of the property, of the trust, and therefore there is some legal and administrative complexities there. Maintenance fees, again, the ongoing, as well as the record keeping, there's ongoing maintenance. And for me, the final one, which is a 10-year charge. So I mentioned an IHT benefit for the long term. There's a 10-year charge on the 10-year anniversary of the setup of the trust. So if you set up a trust today in 2024, in 2034, there will be a 10-year charge of 6% of the value of the estate, of the value of the trust above 325 or 650,000 pounds, depending on how it was created. So that's something to consider, but there's ways of mitigating that too as well. So again, keeping it simple, it's sort of trying to make sure that you are aware going into this structure, what the costs and benefits are.